Good morning, everybody. It's Jeff Fitzpatrick. It is Monday, the 2nd of September, 2024, and this is my weekly video. This week, it is a very special video. I will keep watching. There's a lot of very new stuff, and some of it a bit controversial. So let's get going. We've transformed the performance of the clubs that I manage, which is Diamond, Fortune, Sapphire, and also the Extra Income Club and the Quarterly Income Club. And I also keep a good hand in on the 100th Millionaire. We're going to find out how that transformation has come about. And let me say from the beginning, thankfully, we are not Warren Buffett. Warren Buffett cannot do what we do. He, for example, owns about 10% of Coca-Cola. He can't sell a call on that. He can't sell a put on it, but neither can he dip in and out as the price moves. So we're going to use those advantages to make a lot of money. I'm ready for the next big push. And just a quick reminder for everybody. So how I find stocks. I rely on and use extensively Value Line and the information that they provide, at least some of it. First of all, I start with their 1,700 stocks that they do a full report on. From those, I filter out only those stocks that have got a timing score of 1, 2, or 3, a safety score of 1, 2, or 3, and also a financial standing of at least B+. I'm looking to change this. I'm looking to come back to only have timing scores of 1 and 2. The timing score is actually a 6-month forecast. And I find that the nearer term forecasts are made by Value Line and probably anywhere else, the more accurate they are. So to go for a Value Line stock that doesn't have a 1 or a 2 means that you're going for something which is average or below average in the view of the Value Line guys. And they spend all day, every day doing exactly this, the research. So that gets us down probably now to 170, but with that new parameter in there, it'll come down possibly 100 or less. I then use the charts to look for low price stocks from amongst that filtered out list that have significant lows and where the indicators look good. I don't look for perfection, but I look for very good. That will get me down to 20 or fewer stocks. Then I go into the full analysis using Value Line. I use most of the parameters that are in the 4x4 score analysis, but I also use some more. I want a management score, for example, and some of the parameters I've changed. When I saw on the bottom of the 4x4 score sheet, copyright, I think it was 2003, I decided that there might be some updating to be done since then. We must have learned something. That then gets me a short list. This week it was about a dozen or so. And I then turn to the trading platform to see what's available in terms of premiums and also to see what stock buying power the different stocks will use. Then I separate them out into stocks that are suitable for the long term and suitable for short-term trades. And that's what I do. It doesn't actually take long. All of that can be done within a 2-hour window. Okay, so I'm not going to cover this every week, but as it is the month end, we'll have a quick look and see how the clubs are actually getting on. So I've highlighted really the good news. So we look, for example, at Diamond at the beginning here. They're left in value, so that's the value, net liquid value, plus the value of their yet to expire option premiums is 721,000, so well above now the amount invested. They've got also the value of their shares, and the cash that they hold is also above that which they invested. And the run rate from the 1st of July to the end of August is 5.98% gain. And that is to the left-in value. Now we divide that 5.98 by the 3.5% that the S&P rose over the same period, we'll see that they've advanced by 1.7 times the S&P. They're already at break even, they're above that, and they've got an 18-month period which is forecast to double at the current run rate. And they've got 19 months to go to that 5-year time horizon. Emphasize here that the time horizon doesn't mean the end of the club. It simply means it's an opportunity to take a dividend or to take some money out without leaving unexpired put income on the table. Going across the page then, Fortune are in a similar situation. They're ahead on left-in value. They didn't do quite as well, 4.16 over the period. And I think that's because they started with lower buying power. They will catch up. They're already catching up in September. Teas are not in the same place at all. Moving ahead again, it's a smaller club, started with less buying power in this period, but still a 4% per month improvement isn't poor. And they're 20% ahead of the S&P. However, there is scope to improve that, and we will do so. Sapphire is the problem child, really. If you look at this, they are still well below the amount invested, whether you take the net liquid value or the left-in value. They're moving ahead nicely, 5.3% for each of the last 2 months on average, and 1.5 times the rate of the S&P 500. But at this rate, it's going to take 6 months to get them to that break even. And I'm going to show you some stuff today that for Teas and Sapphire will hopefully reduce that period, and it will also reduce the doubling period for all of the clubs. 100th Millionaire doing very nicely, thank you very much. They had a 6.67% advance on average in each of the last 2 months, and they're nearly twice as fast as the S&P 500. They've been running for a shorter time, and they've also got a shorter doubling time, so that can't be bad. Extra Income Club, they're the newest of them all, and they've got the highest rate of advancement, 8% per month, 2.3 times the S&P 500 rate of growth, already at beyond break even, and have a 17-month doubling period. Now, for Teas and Extra Income, I've got not applicable in the months remaining of the 5 years. These are open-ended clubs. Teas because it's a training club, and Extra Income because it's an income club. And then we've got the overall position, average of 6.28 advancement in the 2 months. That's per month, and 1.63 times the S&P rate. So doing very nicely, thank you. I hope you've had time now to look at this and to spot what's going on with your particular club. Okay, so what I've done here is I've looked at the relative positions of each of the clubs that you've just seen on that scorecard, and I've put them at the starting date when they started against the S&P. So, for example, Tees was the first club to start. That was back in October 2019. And yes, it's positive, but of the positives, it's the lowest. And it did have a bit of a period when it went down here. That's actually the pandemic, so it was a big period of down. But look at the increase that's taken place in the market since then. It's absolutely huge. And really, Tees should be at the top of this list, particularly as it's a club that doesn't actually pay fees until the end of its life. So we need to do something about that. Diamond was the next to start, and it's done a bit better. It hasn't had quite the period of growth to enjoy that Tees has had, but it still should be ahead of where it is now. Sapphire is negative, and it started here, which was at the advance of a big reduction going down. But we've had plenty of time now to recover from that. So again, we need to see what we're going to do about that. 100th millionaire, no problem. It started there. We could probably argue that it should be a bit further ahead than it already is, but it's certainly the best of the bunch. And extra income, the youngest of the clubs, probably again a little bit short of where it should be, but nonetheless are doing reasonably well. But we're going to boost all of these. So that's the position. That's what I think we need to improve. This is the reason why I think that we need to take really strong actions. There's something wrong here. There's something we need to do differently. So let's see what I conclude that it is. So, three things. The first of these is to not compromise on quality. The stocks that we have chosen to sell puts on in these clubs have not always been the best of quality. Now, they haven't been horribly, ridiculously bad or anything, but for example, if you're using the 4x4 list and you're looking at a 4x4 stock, the report that that score is based on could have been nearly 3 months old. A lot can change in 3 months. Also, we have a compromise in lists taking on scores of 3x4. And then we also have stocks which have appeared in the lists, which have been crazy to be in the list. Stocks that have stayed in for too long. For example, SSRM Mining was going fine, had a major underground disaster, which I haven't recovered from, and they probably never recover from in our lifetime. It should have come out. So that's number one. No compromise on quality. The only compromise that I do actually tend to do is if we're already in a stock, then I'll forgive it a little and continue with it. But I definitely don't want to be entering new stocks that do not reach the quality threshold. The second thing is, and this has made the transformation we've had over the recent couple of months, is I am now doing a huge amount of selling and managing out of the money near-term strike price puts at significant low points, low price points. Now, in case anyone's not clear, out of the money, when we're talking about a put, means the strike price is below the current market price of the stock. The confusion with that is if you're selling a call, the out of the money strike price would be above the current share price. So let's have a look at how this is going. So here we have the outcome for August. And this at the bottom of the page here is the extra income club. So you can see that an awful lot of puts were sold. These were basically out of the money near-term puts. However, we didn't win on all of them. There was only one, though, where it ended in an actual loss. That was on Sealed Air Corporation. We sold the 35, we got 70 cents for it. And in the end, if we sold that stock straight away at the prevailing price, whatever it was, then we would have lost $1,150. We didn't get the chance to push it forward. It was put to us before we could do that. The other two in the sort of purple highlight here, yes, they were put to us, but the premiums involved were high enough compared to the price that they were put at to mean that if we wanted to, we could have sold them immediately and got a profit of the figures shown. Overall, amongst all of the clubs, we did $109,000, which was nearly 3% of the value, the opening value of the accounts. If I go up the page, we can see some others. The QI Club, 23,000, no actual losses. 100th Millionaire, nearly 20,000, one actual loss, which is only $300. So then we've got Sapphire, one loss of $860 compared to $24,500 of gain. And then we've got Teas, no losses, Poor old Fortune only came out with the benefit of $395. And I think that's because these puts were not near term. I think they'd actually been sold quite some time earlier. They didn't have the buying power to be able to do what we're doing now. You'll see that that is changing. Then we had at the beginning of the list, our diamond again, no losses, 24,000 of profit. So we roll forward. I just go up the page a little here. We've now got September. We're into September. And at the top, we've got diamond. So still a long time to go, but only one loss at the moment. Could change, of course. Prices could fall, prices could rise, but currently on for 40, call it $44,000 of profit. Fortune, again, there's still some to go up, but no actual losses in there and 15,000 of profit. Of course, it's a lot smaller club. Teas, one loss currently, $100 and 7,000 gain. Again, that's a smallish club, 150,000 or so. Sapphire, one loss, 620 as we stand, and 36,000, call it, of profit. 100th millionaire, no actual losses, 33,000 of profit. QI, they've got a bit to do, so there's one loss of $280 and one of 9,000 on JetBlue. Now, the JetBlue one, what I'll probably do with that is nearer the time, when we get rid of some of the time value, I will roll it forward for a credit. That's what I'll be trying to do. The moment I've got to get rid of a loss, and the loss is only $1.59 per share. That's the other thing. The other 7 cents, 150, $1.59. They're not a fortune, either for the price of the stock to go, or to sell a call, or to sell another set of puts. 29,000 in QI. And extra income, 11,000. Again, only one small loss, which is, again, for the 20th of January, not a problem. There's some more figures to the right here. I'll be coming back to those in due course. So, selling and managing out of the money near-term strike price puts is really making a huge difference. So what comes next? And here it is. This is a major departure. I can't remember the last time that we were just buying stocks. So what I'm saying is, I want to use the money generated by selling short-term stocks and also getting price appreciation, dividends, etc., to buy stocks at significant low price points, and at the same time to set target exit prices. I don't want to be in them for a long, long time. I only want to be in them while they're behaving themselves. This adds a lot of price appreciation, but also it puts available cash to work and creates more buying power to use in the, well, it's actually the second of our changes. So if we have $1 in our account, we get another $1 of buying power. If we hold a stock in our account, a share, we will get either 1, 2, 3, or 4 times the value of that stock in buying power. So if we choose good, solid stocks, we can increase our buying power significantly and therefore do more trading and make more money. That, my friends, is the plan. So the summary of all that is that I'm now satisfied that the biggest cause of the lack of or of reduced growth, not getting far enough in whichever way you put it, is having stock put to clubs at unfavorable prices that can then take months to recover if we ever do recover. It also leads, when we get bad stock put to us, or good stock at bad prices, to having to sell good stock that's in profit, but not necessarily the maximum profit, to pay for that poor stock. That has reduced the overall quality of the stocks in the portfolio. So we need to bring an end to that. There will be occasions when we have to sell good stocks because we've got other stock put to us, but we can reduce the frequency by a huge amount. Now, I'm going to test some of this. I'm going to start doing it immediately, given the agreement of the clubs. But I'm going to do an experiment. Let me go back and show you what I'm doing. Okay, so I'm using the Extra Income Club for this experiment. And I've chosen them because they have got a lot of cash. They've got $97,000 in cash. So what I've done is I've taken the short-term puts that have been sold for September, some of them expiring on the normal monthly date, 20th of the month, and some later in the month. I may well yet add to these. And in addition to noting the stock, the strike price, live current prices, the number of contracts, the commitment, huge, 551,000 overall, the premiums, and the outcome, and of course the gain or loss involved. I've now added some more. So I said, okay, when did this transaction take place? When did we actually sell these puts? And you can see most of them, the earliest one goes back to the middle of July, but most of them far more recently than that. Oh, sorry, there's one there on the 1st of July, CVS. And I've then put the current gain or loss in and compared that to the premium. So if we take the top one, CVS. So CVS, we have sold a 62.50 strike price put. The current price is only 57.24. But we got $5.30 in premium. So we're actually 4 cents up. A miserable $12, but we are up. If we had simply bought the stock at the time, then we would have paid 58.15. And as the current price is now lower than that, 57.24, we'd have a 91 cents per share loss. And that means that compared to the premium, we're actually down $6. So as we move forward, these prices will change. So this will stay in place as we go forward. And we'll see how many of these negatives turn positive in terms of would we have been better off to buy the shares at the price that was available at the time, or was it the right thing to sell the put, the short-term put? Now, you have to have cash available or stock buying power available to be able to buy the shares anyway. So we wouldn't have had enough buying power available or cash to get all of these shares, but we could have got some of them. And the question is, in the long term, would that have been better? It's looking like it probably would. Okay, so we'll be following that as we go forward. Okay, this is another aspect of what we're doing in terms of buying shares. So we've got could be any old stock here. At point one, we will now be buying stock and also selling short-term puts. It really doesn't bother me if we do both of those at the same time on the same stock. That's not a problem as long as we don't get a ridiculously high proportion of the account all in a small number of stocks. When it gets to the top, we sell the stock and sell calls or put in a limit order, trailing stock to start taking us out of it. When it comes back down, it competes with all the rest, but we may well buy the stock again. We may well be selling short-term puts in that stock again, and on it goes. Typically, if you buy a stock at point one and just hold it and sell it up there at point four, then you're going to get a gain, obviously. However, if you buy it at point one, sell it at point two, buy it at point three, and sell it at 0.4, and we never quite hit the exact tops and bottoms, then it will produce 70% more in price appreciation than just having bought at 0.1 and sold at 0.4. So we're going to see a lot more movement in the account. We're going to, in all of the clubs, we're going to see them going into stocks, taking money off the table, coming out, and then going into either that stock or another stock again when it's the right time. That's the direction of travel that I'm urging the clubs to take, and I'm sure they will. You've already seen on the report card at the beginning that we've now got some really good, ridiculously good, in fact, rates of increase. And I think that the third of these actions, buying stocks, will add to it. And it is the time, if you want to invest more, if you've got more to invest, now is the time to get it in. We've got time to double the value of any money that goes in now before we get to the time horizon. So I urge you to get down the back of the sofa, find anything that you've got, and I would seriously put it in. However, do not borrow money to put in. Do not put money in that you can't afford to put in. The only people that have generally left the club so far are people that put money in that couldn't really afford to do so at the beginning. And generally, they've been smaller amounts. We have had the odd divorce, I think, too. My filter for this week. So the stocks on the left, they've passed with basically flying colors. These are stocks that I have been through all 21 parameters on. I've looked at at everything on them. The management score, all sorts of things, and they come through. They're stocks which are sound quality. Now and the charts look pretty good. Now, that doesn't mean to say that they're exactly at the right spot on the charts. It doesn't mean to say that the indicators are exactly right. You might want to time and do a bit of timing before you get into any of them. They might not even have decent premiums. They might not even have, they might have very, very high use of stock buying power and so on. So this is not the end of the job. This just gets you to a short list. I've got a few more there, which didn't quite make the grade, AMX, AOS, and CMCSA. They are acceptable quality to me, even though they didn't quite make the grade. So that means they've got one or two of the 21 factors where they are not across the line. But I wouldn't have them up there if they weren't pretty good quality anyway. So that's my list for the week. The Sunday night webinar next week will consist of, we'll see Anna's list as usual, and Owen and I have agreed that rather than use the 4x4s and 3x4s, I'll be putting up the stocks that actually make the grade for my first filter, which is, not sure yet, 1, 2, and 3 for timing, or 1 and 2 for timing, 1, 2, and 3 for safety, and B+ for financial standing. And then on the following day, you should then see my video where I'll have been through those stocks, picked out a list like these. Facebook group is coming soon. It's very, very busy at the time, but I'm very pleased with the amount of thinking and planning that I've got in for this. I wanted to launch with a bang. I wanted to launch successfully. I don't want it to come in as a whimper. Most of you are probably aware that we have a club called the Young Stars Club. It is basically for young people. I'm talking about people who are basically 16 or under. And as we stand, they can put sort of £500, or the parents can put 500 in. And the parent or guardian, whoever it might be, is actually the member on behalf of these youngsters until they're old enough at 18 to take over the account. However, that account is currently only worth about $7,000, so it's not huge. So in the coming week or two, I'll be making some announcements about this club. I want to get it above the $25,000 account value threshold so it can take advantage of selling short-term puts and use the same strategy that I've been outlining in this video. Now that's going to create an opportunity. I've got to get my head around exactly how I count that and who it's open to and so on. But keep your eyes open. That's coming in the next week or two. If you're not already a member of one of our investment clubs, then having seen the figures that we're achieving, you might want to come in and join us. You can do so. You can pick your club, apart from you can't join the 100th Millionaire unless you're a member of the networking group of that name. You can't join the Tees Club because it's basically an apprentice club that I've invited people to join. If you want to join the Quarterly Income Club, then there's a minimum investment of £100,000. If you don't want to put 100,000 in, you do want to be an income club, then the Extra Income Club is the one for you. Okay, so we've also sorted out the venue for the next live training in England. Well, in England, Scotland, Wales, couple of that. It is on Friday, the 11th of November. It starts and then it's all weekend. So Friday evening, Saturday, Sunday. The Hilton Hotel in Watford is now the venue. Friday evening, we should get some live trading in, and it's a really good introduction for people who want to find out more about us before they get involved. Saturday is an intense day on seeking out quality companies. Sunday is about how we trade those companies, including quite a section from me on how I'm trading them as well. And this will be the first time that I presented that in detail. So you can book, and you can book any combination. If you wanted to, you could come on the Friday evening and the Sunday, or you can come for the whole weekend, or you can just come for the Friday, just Saturday, just Sunday, or whatever. And the booking is now live. It's on the website, myinvestmentclub.co.uk. On the front page, you'll see a button for Watford Hilton training. Click on that, pick out what you want to do, find out more about it, and you book and pay for it there. Not forgetting another plug for the book. That's still going well. Incidentally, the next version of the book, or the book I'm now working on, is almost a training manual for the way that I trade. It's going to be very, very detailed. It will be a loose leaf document, so that as we develop and improve things further, we'll be able to remove sections, replace them, and so on. And I'm hoping that I will be able to launch that at the live trading at the live training in Watford in November. And I think that's about it for now. Thanks very much for listening. Love you all.